Okay, let's dive in. We are taking a deep look today at something pretty significant happening across Southeast Asia. It's a shift in workforce demographics.
Yeah, we've got some really fascinating data, particularly focusing on Japanese expatriates.
Exactly. Some people are even calling it, the great expat exodus.
Yeah.
Sounds dramatic, maybe, but what happens when a major corporate group starts, well, leaving a key hub like Thailand?
It's more than just numbers dropping off. It signals a really fundamental strategic change for big multinational companies.
Hmm.
And it triggers lifestyle changes too, which, definitely impacts market demand, especially in real estate.
Absolutely. So, our mission today is to give you the essential breakdown. Why is this happening? What does it mean for investment, particularly maybe in property?
And what kind of demand is actually replacing that traditional high-level expat?
Right. We've sort of boiled it down to three core drivers behind this trend.
That's right. The general picture is, well, fewer Japanese professionals living and working long-term in Southeast Asia. For decades, the model was clear, right? Send senior managers from Japan,
Standard operating procedure.
pretty much. But that model is clearly evolving, or maybe breaking down in some ways.
Okay, let's start with the biggest one. The most deliberate factor seems to be this corporate pivot towards localization. We hear that phrase, prioritizing local talent, but what's actually going on there strategically?
Well, fundamentally, it looks like companies did the math, and localization saves money, often a lot of money, while boosting effectiveness.
How so? The cost side seems obvious.
Yeah, an expat package is incredibly expensive. You've got tuition for those international schools.
But they're not cheap.
Not at all.
Oh.
Then there's housing allowances, often for large premium places, flights home every year, sometimes tax adjustments.
Mm-mm.
It can easily cost multiples of what a senior local manager earns.
Okay, but hang on. Wasn't the justification always about control? Maintaining the corporate culture, having that trusted person from headquarters. Why are they seemingly okay with outsourcing that risk now?
That's the critical point, I think. The strategic thinking has shifted. Our sources suggest companies now see the risk of not localizing as actually greater.
Interesting. How so?
Well, local managers, especially in a dynamic market like Thailand, they just get it. They have this deep, intuitive understanding of consumer tastes, the local regulations, how the supply chain really works on the ground.
Stuff an expat might take years to figure out, if ever.
Exactly. Stuff an expat who's maybe spending half their energy just adjusting to the culture simply can't match quickly. So localization isn't just about cutting costs anymore. It's seen as optimizing how the business actually runs and tailoring products for genuine, sustainable growth.
That makes a lot of sense. If you're selling in Bangkok, you need someone who truly understands Bangkok, not just relying on directives from Tokyo.
Precisely.
And the investment angle there is pretty stark, isn't it?
It really is.
Yeah.
Just think about the direct impact of that corporate strategy shift alone. We're talking about fewer of those premium, short-term, corporate-backed leases.
The guaranteed income for landlords.
Exactly. Often inflation-proof, high-yield income.
Yeah.
If that demand starts drying up, it puts real pressure on certain types of properties, specifically the large amenity-heavy units built for those packages.
So investors who banked on those guaranteed expat rents might need to rethink their asset strategy.
Absolutely. It's a potential repositioning challenge.
Yeah.
The market might be shifting from serving big corporate budgets to meeting local professional salary expectations.
Okay, so that's the corporate side pushing for change, but you mentioned another driver, something more societal.
Yeah, this is the second major force,
Mhm.
and it's about who's actually willing or able to take those assignments anymore. It connects to, well, global shifts in family life.
Right. You mean the rise of dual income households.
Exactly. Across professional classes, certainly in places like Japan, it's much more common now for both partners to have significant careers.
Yeah, I can see that. Historically, the assumption was often the whole family moves, and one partner, usually the spouse, puts their career on hold.
Right. That was often the expectation and the reality. But think about it now. When both partners have established valuable careers, asking them to relocate overseas, that forces a huge professional sacrifice on one person.
It's not just an adventure anymore, it's potentially derailing one partner's entire career path for 3, maybe 5 years.
Precisely. It significantly impacts long-term earning potential, retirement savings, the whole joint financial plan.
So there's active resistance, people are turning down these assignments more.
The data suggests yes. This resistance is real, and it's forcing companies to rethink their entire expat policy framework. They might offer shorter assignments, or maybe they become less frequent, perhaps reserved for really specialized roles you just can't fill locally yet, or maybe more junior staff looking for experience.
So it's structural. It's not just a phase. It's tied to these bigger societal shifts in like family wealth and career equality.
That seems to be the case. It looks pretty long-lasting.
Okay, so you have companies wanting more local hires, and you have fewer traditional expats willing or able to move. That does sound like a perfect storm for a demographic shift.
It does.
Does the actual data on the ground back this up, like across the region?
It certainly seems to, and Thailand is a really clear example here. Thailand has always been a huge destination, right? A top choice for Japanese expats for years.
Definitely.
Yet, the sources we looked at confirm a noticeable, measurable drop in their numbers there over the last 3 years or so.
Okay.
So yeah, the trend in Thailand really serves as a solid confirmation.
Right.
It mirrors the broader regional pattern and shows these drivers the corporate strategy, the family dynamics are consistently reshaping things across Southeast Asia.
Right. Which brings us neatly to segment 2. What does all this actually mean for you, the listener, if you're perhaps an investor or a buyer looking at property markets, maybe in Bangkok, maybe the Eastern Seaboard, places where that expat group used to be really dominant?
Yeah, the key thing to grasp is that demand hasn't necessarily vanished, but its character has changed. It's undergone a bit of a metamorphosis.
Okay.
The expat is often being replaced by a local hire, so we need to understand this new tenant or buyer profile.
So we're moving away from, say, a guaranteed corporate lease for a Japanese manager to maybe a private rental contract with a Thai executive.
That's the general shift, yes. And that new tenant likely has different needs and, crucially, a different budget framework.
Okay, what does that look like? What does this new tenant demand?
Well, first off, potentially a smaller footprint. Those old expat packages often covered, big 3-bedroom, 150 square meter apartments near the top international schools.
Right.
The local senior manager, they're probably working with a localized housing allowance or just their salary. So demands might shift pretty quickly towards, say, smaller 2-bedroom units, maybe 80 to 100 square meters.
And location. That changes too, right?
Absolutely. The priorities shift. The local manager isn't automatically focused on being near those specific high-fee international schools or living in the traditional expat bubble areas.
So what are their priorities likely to be?
Things that align more with local life. Good access to public transport, maybe proximity to good domestic schools, general convenience, and crucially, affordability relative to their local salary band.
Which could mean the prime investment zones might actually shift away from some of those traditional expat hotspots.
It could, yes. Towards areas that have strong appeal for local executives and professionals, it requires a more nuanced understanding of the local market dynamics.
This feels like a really important point for anyone underwriting a potential investment. You can't just look at overall vacancy rates and say premium buildings anymore.
No, you really have to dig deeper. You need to understand the type of tenant in that building. Are the current leases mostly corporate-backed, tied to those global expat assignments?
Because those are now the higher risk ones.
Exactly. Those leases look the most vulnerable in this changing environment. The new, localized demand is likely based on private rental agreements tied to local executive compensation levels.
So investors need to benchmark differently, not against global expat package standards, but against, say, the typical housing allowance for a general manager hired locally in Bangkok or Rayong.
Precisely. And that often means accepting potentially lower absolute rental income per square meter, but maybe gaining more stable long-term tenants if you have the right kind of property in the right location for that demographic.
It's not just about smaller units. It's about understanding the mindset of the new target renter. They might value, I don't know, local convenience over imported luxury finishes. It's a subtle adjustment.
It is. And there's another layer, too. If you zoom out, this whole localization trend suggests companies are putting down deeper roots.
How do you mean?
Well, hiring a local GM isn't usually a temporary fix. It signals a commitment to long-term in-country operations. That stabilization over time should create a more stable base of demand from local professionals.
Assuming the supply side, the developers can adjust.
That's the key variable. Developers need to recognize this shift and potentially reposition their premium offerings to meet the needs and budgets of this emerging local executive segment. If they don't, you could see oversupply in certain niches.
Right. So the speed of that market adaptation feels critical right now. Okay, so just to recap, we've really uncovered these key drivers: Corporations chasing efficiency and local expertise.
and potential expats facing resistance from dual career family realities.
And we've seen how this isn't just theory. The data from Thailand clearly confirms this trend is well underway.
Yeah, and if you connect all this to the bigger investment picture, it really raises a crucial question for anyone involved in the market.
Which is?
When corporate strategy makes such a fundamental shift from relying on international staff to empowering local talent, how quickly can the real estate market possibly adapt? Because property development cycles are long, right?
Much longer than corporate strategy shifts sometimes.
Exactly. So how fast can inventory, pricing, amenities adjust to avoid potentially painful periods of oversupply in those segments previously dominated by expats?
That speed of adaptation, that's probably what separates the successful investors from those left holding, yesterday's assets. We really hope this deep dive gives you useful data to think about your own next steps.
Absolutely. If any of this sparks specific questions about opportunities you're seeing, or maybe how these shifts affect investments you're already considering, we want to help you dig into that further.
For that, head over to moveandstay.com/request. You can explore how these demographic and strategic shifts might specifically impact the property types and investment decisions you are thinking about right now.